tax trap before 2029 for sure. Or you're going to be kicking yourself. It's time to reposition IRAs or 401ks to a tax-free vehicle, okay? Perform a strategic rollout at low tax rates instead of waiting for higher tax rates in the future, okay? Taking RMDs, required minimum distributions, is horrible advice, okay? It's likely not saving you tax. It's compounding your tax, and most people don't think that. It's very myopic. You think you're saving tax, that's only in a single year. You spread it out over the years, and you're actually doubling and tripling the tax you would pay, okay? Here's a real popular video that maybe you saw in order to register. 6 mistakes people make when taking money out of their 401k. What were they? First of all, postponing taking money out beginning at age 59 and a half. Once you turn age 59 and a half and you don't have a 10% penalty, I would seriously look at starting to get money out of that IRA or 401k. Not that you need to live on the money. You just want to get the taxes over and done with, and you reposition the after-tax money into something that's tax-free from now on. 2, only taking out the minimum needed, thinking you're saving tax, rather than taking advantage of all the room in your current tax threshold. I'll explain that here, okay? If you're a single taxpayer right now, in the year 2026, your taxable income after deductions, if your taxable income is between $50,000 and $105,000, there's $55,000 of room that you can get money out of an IRA or 401k and only pay 22%, because that's going to go up to 25 probably in the year 2029. Between 105,000 and 200,000, there's 96,000 of room. Even if you don't use that room, you're going to lose it. You can't go back and retroactively file a tax return and take out money. For married couples filing a joint tax return, taxable income between 100,000 and 211,000, that's 110,000 of room. If you don't use it, you're going to lose it. Between 211,000 and 403,000, that's 192,000 of room. So what does this mean? If you and your spouse have a taxable income of 250,000 this year, you have room to pull out another 154,000 out of an IRA or 401k and still only pay 24%, no more. And that 24 is going to go up to 28. People say, well, that's only 4% more. It's 16.66% more, okay? If you only had to pay 24, that's $240 in every thousand. If you go up to $280, that's $40 more. $40 is 16.66% of 240. It's a 16.66% increase in the money you will shell out if you don't get in gear and look at a strategic rollout instead of putting it off. So repositioning tax withdrawals, you get it down, you pay the tax into something that's taxable. That's not smart. You put it into something tax-free that will actually reimburse you someday when you die, okay? For all the tax you paid. Not having a withdrawal strategy based on your optimal tax bracket, because your current tax bracket is likely the lowest you'll ever be in. Taking RMDs or using the 4% rule. If you don't know what that is, I'll give you a highlight here in a moment. RMDs is, I think, the worst advice for most Americans. And many people get duped into taking them thinking they're saving tax. And last of all, leaving behind 401ks and IRAs to non-spousal heirs. You can't believe how many CPAs, when I teach them, they go, oh, wow. That is the worst place to leave money when a husband and wife pass away is to your kids in IRAs or 401ks. They have to pay tax on that within 10 years. They can't put it off until they retire, okay? It gets taxed to death. So is your retirement nest egg too top heavy and yet to be taxed IRAs or 401ks? Let's go back to those 4 areas. The purple bucket is where 91% of Americans are way too top heavy with money in yet to be taxed IRAs or 401ks invested where? In the stock market, in mutual funds. Wall Street was not designed to create predictable income. That's why they have what is called the 4% rule. Okay. Now, some people have real estate. Okay. But a lot of people are sick and tired of taking out the trash, fixing toilets, evicting tenants, being a landlord, but they're stuck. They think they're stuck because they've been doing 1031 exchanges. They don't want to pay a capital gain. Hey, we do analysis, and many times people just bite the bullet, pay the capital gain, and they take the remaining 80% because capital gain rates are low right now, and they put it into a portfolio of laser funds, and they get more cash flow than they were getting being a landlord, and they don't have to be a landlord anymore, okay? Also, some people like what we call the orange bucket, guaranteed income like Social Security or maybe a school teacher, police officer, firefighter pension, or an annuity. That's based upon your risk tolerance. But the most underutilized and my favorite is the green one, the tax-free one. Now, municipal bonds used to be popular. They're not anymore because municipalities are filing bankruptcy left and right. Roths, you already know I'm not a fan of Roths. Why would I mess around with a Roth with all the rules and strings attached when I can get rid of all those and use a max funded tax advantage laser fund because it has the two benefits of a Roth and four additional benefits Roths will never have, okay? Now, what I've been talking about is getting money out of this purple bucket. If you have money in this purple bucket, you ought to consider doing a strategic rollout. That's not the only strategy today, but it's a big one. To get it down here to what? The green bucket. Convert the purple to tax-free, to green. Now, you have to pay tax, but you better get that tax over and done with sooner than later. Does that make sense? Okay. I recommend no more than 30% of your income ought to be in that purple bucket when you retire, at retirement. If you own real estate, I would recommend no more than 30% of your retirement be reliant upon having tenants. I can show you how to have income out of your real estate, even if they're vacant, okay? I recommend, based on risk tolerance, between 0 and 80% of the orange one, but I've already told you, I recommend that 40 to 60% of your retirement income not even show up on the front page of your 1040 tax return. It's tax-free, okay? So there's 3 steps I have explained here, converting IRAs and 401ks to tax-free income, and an advisor can help you go through this. Strategically reposition retirement funds, subjecting them to tax. Get the taxes over and done with based upon your current tax threshold, or you'll miss it, okay? Number 2, you reposition the after-tax monies, not into taxable investments, into tax-free that will accumulate tax-free from now on, but when you ultimately die, it blossoms and reimburses you for the tax you paid during the rollout, okay? And then number 3 is a tax strategist, sometimes by helping you maintain some of your tax deductions, you can take advantage of getting money out of those IRAs and 401ks with the least tax consequence, okay? Now, ever since 1986 tax reform, there's only 3 types of income Americans pay tax on. This was President Reagan's second term. Earned income, which is salaries and wages, passive income, which is rents and leases, and portfolio income, which is interest and dividends. So people ask, well, why is money out of these laser funds tax-free? Well, the simplest answer is because it's not any one of these 3. Now, when our clients have, for every $1 million in a laser fund, they have 100,000 of tax-free income that doesn't deplete principal. The IRS knows they're receiving that 100 grand a year, but it's not even worth auditing because it's never been taxable, okay? And so in the book that I want you to claim by having a free consultation with one of these advisors, you'll read stories, especially in the right brain side about school teachers, that we saved $250,000 of unnecessary tax on their 401ks and 403bs and TSAs, okay? A landlord, we saved $250,000 and quadrupled his income, okay? Husband and wife, both physicians, had saved $4.6 million in their IRAs or 401ks. When I told them that if they kept taking RMDs, they were going to pay $2.6 million in tax by stringing it out, they were shocked. And their advisor said, well, they can afford to pay $2.6 million in tax. Look at how much money they've got. I said, well, let's ask them. I said, I can't save you 2.6. I can save you 1.2 million. Would you like me to help you do that? Absolutely. We saved them 1.2 million of otherwise payable tax. That is in a laser fund generating 100,000 a year of tax-free cash flow for generations. Okay, folks, we took a California couple from the highest tax bracket to a 0% bracket. They didn't want 40 to 60% tax-free. They wanted 100% tax-free. When they came to us, they had $6 million in IRAs and 401ks. They bit the bullet, paid $2 million in tax, took the net of $4 million, put it into 4 IUL laser funds, 2 on the husband, 2 on the wife, and that has doubled to $8 million in 7.5 years. It's generating 600, 700, 800,000 a year of tax-free income. But they only need 300,000 to live on. They can hedge against inflation, okay? We had a couple come to us from California with $2.6 million in their IRAs or 401ks. And they were thumping themselves on the chest. Well, we've saved $2.6 million. And we think with a 6% payout, we'll be able to enjoy $160,000 a year of income. I said, well, congratulations. You're in the top 1% of Americans, but I see one big problem. They said, what is that? I said, well, that and your Social Security or your pension, that 200,000 is all showing up on the front page of your 1040 tax return. It's all taxable. They said, you mean there's another way? I said, absolutely. They said, where have you been? I've been here all along. Folks, they were going to pay 54,000 or more in tax every year the rest of their life. In 5 years, we rolled out and got 120,000 of that 200,000 off of their 1040 tax return. They now enjoy the same income, actually more, but let's compare apples to apples. For the same 200,000 income, they only pay 21,600 in tax. We save them $32,400 a year, and that has gone up. 800,000 over their lifetime to life expectancy. It's going to be over $1 million, and we do this for people all the time. We save them over $1 million of unnecessary tax. So how to safely double your net spendable income? So let me just go back to this 4% rule for a second. The financial services industry, Dalbar, who studies investor behavior, says that unfortunately, the average American with money in the market, when the market starts to nosedive, especially if this is their retirement nest egg, and it drops down 15%, then 20, and then 25 and 30, a certain percent of Americans go, enough already, and they sell. They sell low. And then they wait till the market turns around and comes back up, and then they buy back in high. If you bought and held in the market, you would average about 9.14%. You'd net 6 after tax. Most Americans are not earning that. They're earning 3.49%. So the financial services industry came out with what is called the 4% rule. They don't want to be sued for you outliving your money. So if you're only going to earn an average of 3.5% with money in the market and you pull out 4%, you're going to slowly deplete your nest egg, but not before your LE. LE is life expectancy. If you take out more than that, they want you to sign a waiver, a hold harmless, that you won't sue them. Okay. Now, how pathetic is this? It's unacceptable to me. That means you would have to have $1,250,000 nest egg to generate a 4% income, 4% payout, 50 grand a year before tax. In a 28% combined federal and state tax bracket, I say this because 41 out of 50 states has a state income tax. You're going to pay $14,000 in tax and net $36,000 a year or $3,000 a month. I don't know if you're like me, but I don't accumulate 1.2 million to have a measly $3,000 a month of income. IUL laser funds for our clients, that same $1,250,000 generates an 8% payout, no brainer. Okay, $100,000 a year tax-free income. And then we show you how you can get a 10% payout using a special smart way to access money. How would you like to have 125,000 of income instead of just 36,000? Why would you generate 36,000 in annual income when you could generate 100,000 or more is my question. Okay. This landlord I was talking about, real estate landlord, when he came to us in 2012, he finally had 600,000 accumulated in his IRAs. Do you know that's how much he had in the year 2000, 12 years earlier? But because of the Great Recession, that 600,000 went down to 360,000 twice, and it was barely back to break even. And his advisor came in and said, I told you the market always comes back. And then his advisor had the audacity to say, now, don't take out more than 4%. That's a ridiculous 24,000 a year. After tax, he was in the 33% bracket. He was netting 16,000 or 1,300 a month. We did a strategic rollout. He had 600,000, and we were able to get a better rate of return on that while he was rolling the money out over a 5-year period, like I was talking about. And so we rolled out 150,000 a year. Worst case, if he paid a third, 50 grand in tax, he's netting 100,000 times 5 years. He has 500,000 in his IUL laser funds, and that generates 50,000 a year of tax-free income. That's 3 times what he was getting. We do this all the time. Now, in actuality, we got 750,000 out of his IRAs or 401ks with no tax because we resurrected deductions on 4 rental properties that he had, which offset the tax by resurrecting deductions he'd been killing by sending his extra principal payments against the mortgages. Okay, and he was making 3 times more than the cost of the net cost of the mortgage in his laser funds. Okay, folks, this is what I'm talking about. And at the end of the day, when he dies, it blossoms to 1 million. Why wouldn't you do that? Why would you generate this much when you could generate 3 times that? And not or, why would you leave behind this when you could leave behind double that? Right? The second danger is inflation that affects everybody. In my opinion, it's going to double the cost of living probably in less than 5 years. Why? Folks, if you're not aware, I started in 1974, okay? I'm an old geezer. I might have an Apple Watch on right now, but my first watch was a sundial. My first pet was a dinosaur. That's how old I am. Now, back in 1974, when I started, that Carter got in, and by the third year of his term, we hit double-digit inflation. And then in the 1980s, Congress decided they could not afford to pay Social Security recipients the true rate of inflation, the true CPI, the inflation rate. And so from that point forward, instead of comparing the same basket of goods and services year to year, apples to apples, they can actually compare the price of an 8-ounce filet mignon steak last year to 8 ounces of hamburger this year, and they do it. So the reported inflation is shown here in the red for the last 40 years. The true rate of inflation is in the blue. It's always double or triple that. We saw that here in the last 20 years. During COVID-19, okay? Right here during COVID-19, people knew when the Congress came and said, oh, we're going to give you Social Security recipients a 9% raise. Well, people knew that eggs and used cars and all of these commodities out there, gas, didn't just go up 9%. They knew they were paying 20 and 30 and 40 and 50% more. And it's because the true inflation rate is usually always double or triple what they say. So you have to hedge against inflation. If you want to know how to do that, we use rule of 72 math. Usually you'll take an interest rate you're earning on your money and divide that into 72, and it tells you how fast your money will double, okay? Well, the same thing is true to calculate the effective inflation. 5% inflation divided into 72 means the cost of living doubles every 14.4 years, so every 15 years. Well, when they report inflation's 3, it's really 6 to 9. They were reporting 9%, which is really 27. At 15% inflation divided into 72, the cost of living will double in 4.8 years. Now, I think for the next few years, it's going to hover right around here, where you're going to end up having to have twice as much money in 5 to 7 years in order to buy the same gallons of gas and loaves of bread that you could buy, 5 years earlier. Folks, our IUL laser funds, we diversify. And so here's an example of an annual statement where 20% of this client's money was allocated to one of each of 5 strategies, and they got returned 14% on 20% of their money, 10 on another 20%, 15 on another, fifth of their money, 8% and 13. You add all those up and divide by 5, they're averaging over 10%. If our clients average 10.07, they're netting cash on cash after all expenses around 9.62, okay, which will double your money. 9.6 divided into the rule of 72, your money doubles every 7.5 years, okay? Danger number 3 is market volatility, which I think is going to continue for several years. Here's that great recession I talked about from 1999 to 2012, where most Americans lost, okay, 2001, 2003, 2004, okay? And then it took 4 years to make back what they lost, and then 2008, and it took 4 years, and finally they had 1,046,000 for the million they started with 12 years earlier. Now, our clients did not lose during those downturns. Let me show you what happened, okay? With IUL laser funds, when the market crashes, you may not make anything, but you don't lose, okay? And Will Rogers once said people get more concerned about the return of their money instead of return on their money when things get bad. So that's called zero. It's a 0% floor. You don't make anything, but you don't lose. So when the market dropped in 2001, our clients got a 0. Now, if they just sat around and never came in for annual reviews, in 2002, when the market kept crashing, they didn't make anything, but they didn't lose. And also in 2003. But then the market turned around and we had them come back in. And then 2007, they got 0 in 2008. Now, folks, why am I showing you this? Because every 10-year period since the Great Depression, there's usually 7 gain years compared to 3 loss years. Okay, this is the only 10-year period since the Great Depression that there were 5 down years and only 5 up years. And IUL laser funds did what? Well, in 2004, they capped out at 17. I'll show you what that is in a second. And in 2009 and the other 3 years, they got whatever, a portion of whatever the market went up. The average return was 7.23%. Even though 5 years, you didn't make anything, but you didn't lose. 7.2 divided by the rule of 72. If you had $1 million when you started, you ended up with 2 million. Your money doubled, tax free. But our clients didn't experience that. See, when they came in for annual reviews, they earned zero in 2001 because nobody saw the terrorist attacks coming. But we saw people who were rubbernecking on the economic freeway. And so we just moved back to what is called the general account portfolio. And they got 5%, and then 5%, and then 0 in 2007, 2008, they got 5. So we swapped out 3 of the zeros for 5%. They still got those caps to 17 and 16. But guess what the average return went up to? 11.17. Folks, this is why you want to work with a professional, the ones that I'm going to have meet with you if you want to ask questions, okay? If you would have put in $500,000 into the actual S&P 500, the market, back in 1975, the year after I started, it would have been here in the red, that roller coaster ride, okay? And you would have ended up with 5.6 million. Most Americans didn't accomplish that because when the market crashed, they sold low, okay? But if you would have had indexing, okay, you may not have made anything, but you didn't lose. You would have ended up with 8 million. So I'm going to ask you, would you like a roller coaster ride to hopefully end up with 5.6 million, but you have to pay tax on that in an IRA or 401k to net 3.8? Our clients, no heartburn, and they would have 8 million. Okay, which would you rather have? So folks, where does all this happen? In the Internal Revenue Code, you're going to learn when you meet with these advisors that money that accumulates inside of an insurance contract does so tax-free under Section 72E of the Internal Revenue Code. When you want to access that money for living benefits, it's tax-free under Section 7702 of the code. And when you ultimately die, it blossoms, it increases, and it transfers tax-free under Section 101A of the code. Now, what you're doing is you're using a life insurance contract for the opposite purpose that most people do. Instead of primarily for the death benefit, it's primarily for the living benefit. And this was the brainchild of E.F. Hutton, and they introduced this concept in 1980. And they said, what are we trying to do in the stock market with our clients, trying to earn, an average of 12 when they're not netting 12, they're having to pay tax. In a 33% bracket, if you earn 12, you're netting 8, and they charge people 1% asset management fees on that. So that's another 1%. So you had to earn 12 to net 7. They said, why don't we just earn 11 and net 10? By using insurance, because the multi-trillion-dollar insurance industry are the best money managers in the world. They're the backbone of America, the backbone of the world. This is where banks and credit unions put 30 to 40% of their money, tier 1 assets, for liquidity and safety in insurance companies. Just bypass the middleman, okay? Now, this all happened back in 1980. And in the 1980s, there were 3 tax citations. Tax Equity Fiscal Responsibility Act of 1982, spells TEFRA. The Deficit Reduction Act of 1984, spells DEFRA. This dictates the minimum death benefit required based upon the person's age and gender to accommodate the amount of money that you want to set aside for your future. And then in 1988, June 21st to be exact, the Technical and Miscellaneous Revenue Act was passed, and that tells you how fast you can fund it because banks and brokerage firms couldn't compete. And so they lobbied Congress to slow the flow of money that left their institutions to these because they couldn't compete. Because they paid higher interest, they were safer, they blossomed when they died. But they didn't want to kill these because this is where they put 30 to 40% of their tier 1 assets themselves, okay? Now, when somebody comes to me and they want to optimize assets, I'm going to use a simple, quick example for you. When I say optimize, they want to increase the liquidity, the safety, the rate of return and tax benefits on money that does not have the same laser score of where that money is, okay? So I'll give you a real simple example. If somebody comes and they say, okay, I got to get my money out of the volatile stock market, and I have, 300,000 in IRAs or 401ks, I'm just going to bite the bullet and pay the tax because I'm not saving tax by waiting, and I'm going to net 200,000 out of my rollout, okay? I have a rental property. I'm sick and tired of being the landlord. This is an albatross around my neck. I'm going to sell it. I'm going to have 200,000 net from the sale of a rental. And I have 100,000 sitting in a bank or credit union earning a pathetic rate of return. Okay, so let me optimize that to increase liquidity, safety, rate of return, and tax benefits. That's 500,000. So let's say this is a 60-year-old. We come in and we put 500,000 and we grandfather the 60-year-old to be able to put in 500,000. And we want not the most insurance we can get. No, we want the least insurance we can get away with. That's about $1 million. Okay. Because why are we doing it? Here's why. Under TEFRA and DEFRA for male age 60, I can get by with $1 million of death benefit that keeps this tax-free under TEFRA and DEFRA. Now my money is accumulating tax-free and I can generate tax-free income. Back in the 80s, I had people put it in 500 grand and taking out 50,000 a year tax-free income right off the bat. Now TAMRA says, no, you have to slow the flow. You could put in 125,000 a year the first day of the first year and 125,000 the first day of the second year. And third year, in 3 years and 1 day, you can have your 500,000 in there, and your advisor will show you an illustration of what this means to you. But hey, at that point in time, possibly just 3 years and 1 day in, the net amount at risk is the difference between your money and the original death benefit. The insurance company is only charging you for 500,000 of net amount at risk, because 500,000 of that, if you die, is your own money. See, the spigot on the bucket, which is the cost of the insurance, the IRS says has to be there. So your money grows tax-free and you can generate tax-free income, is actually watering a money tree because you're self-insuring. Now that 500,000 earning 9.6% if it's managed right, will double in 7.5 years to $1 million. Now, what's the net amount at risk? Your cash in there in that bucket is equal to the death benefit. The cost of insurance is Zippo. Now, if you die, they pay out about 5% more than that. But folks, the cash value equals the death benefit. And that can happen in 10, 12, 15, 20 years based upon your circumstances. Okay. Indexing simplified. If I have $1 million accumulated in an IUL, I can settle for what is called the general account portfolio rate anytime. Okay. And that's like the 5% that people were getting during after the 9/11 terrorist attacks in 2008. The lowest I've ever seen the general account portfolio rate is 4%. That's where the insurance company invests their money in AAA and AA bonds and mortgages on shopping malls and skyscrapers, okay? Anytime you want to just earn that, you can settle for 4% if you feel bearish about America. You think we're headed for a recession. That's 40,000 tax-free. In 2008, banks were paying less than 1%, and people could choose 4 or 5% and earn 5 times more than the banks were paying, and this was tax-free. But if you feel bullish about America and you think the economy is going to grow, which I do, you can link, okay, some or all of the $1 million to an index or indices of your choice. Okay, let's go for it. Let's link $1 million. Now, I am not telling the insurance company to take 1 dime of my $1 million and invest it in the volatile stock market. That $1 million has to stay safe in the insurance company, earning 4. What am I giving up? I'm giving up the for sure 40,000 of interest on that year. And I'm saying to the insurance company, do whatever you need to do that 40,000 to have the wherewithal to pay me whatever the market does if it grows. It funds an option budget. They're big boys and girls. If the market goes up 8%, I get 80 grand. If it goes up 12%, I get 120,000 credited that year tax-free. Now, how can they afford to do that? That's what options do. They double and they triple. Maybe up to a cap. The trade-off is if I guess wrong and the market tanks, the options expire worthless and I don't lose the $1 million of principal. What does that mean? When you meet with a trained professional, then you take advantages like March of 2020, COVID-19. Okay, the market dropped 30%. When there's anxiety, that spells opportunity. We contacted 800 of our clients and we switched them to a 1-year point-to-point no cap. It's called a threshold strategy. Whatever the market goes up to, you get that minus 5%. That's called a threshold. That year, from March of 2020 to March of 2021, we knew when the market dropped 30%, the likelihood it was going to go up was very high. And it did. It went up 66.33. Minus 5. This client, 800 of them, got 61.33% in one single year. 852 grand. 1 year later was worth $1,387,000. They made $500,000 in 1 year tax-free. Now, here's the kicker. If the next year the market would have crashed, they would not have lost 1 dime of that $500,000 they made the year before, because that gain is locked in. Okay. They might earn 0, but they don't lose. Okay. So that's the magic. Folks, I'm not a doomsayer, but I am a realist. If you think that the USS economy is going to ultimately be a sinking ship, for many reasons. It's unfortunate because a lot of our congressional revenuers, they're rearranging deck chairs on a sinking Titanic, thinking they can spend their way out of a recession. It's simple math. If your outgo exceeds your income, your upkeep will become your downfall. So if that ship sinks, I want you to stay afloat financially. We can show you how to do that. And so I just want you to know that a 401k is not the cat's meow we thought it was, okay? Uncle Sam's going to have to take a bigger and bigger piece of the American taxpayers' pie. So I want you to learn more by getting a copy of my Laser Fund book. This will be a gift to you when you take advantage and fill out your survey and meet with one of these IUL professionals. And then I've just been talking about retirement. IUL, the Laser Fund I'm talking about, is like a financial Swiss Army knife. It's the dream solution, not just for retirement and a death benefit that comes along for the ride, but my heavens, it knocks the socks off of a 529 college savings plan, working capital for business, real estate management, emergency funds. We talk about lump sums, capital transfer, estate planning, pension maximization if you're a school teacher, tax reduction like I've been showing you. Today, we are focusing on the least understood and those that have the greatest impact for you. So my invitation is to eliminate the dangers of taxes, inflation, and market volatility. Seize these opportunities to convert to tax-free. Link your returns to the things that inflate so it doesn't hurt you. And use indexing so you don't lose by having money in a volatile market. Maintain liquidity, safety, and earn predictable rates of return. I want to help you raise your score. And so as we do that, I invite you to go through what we call an 8-step, very predictable process. It's a transformation. And as you meet with these advisors that I'm going to allow you to ask questions of and see how these principles apply in your particular set of circumstances, they will take you through, if you would like, this 8-step process that will absolutely transform and make you immune from outliving your money. You're gonna have so much more peace in your life. Take advantage of this. So listen very close. I'm going to slow down here for a moment and just make sure everybody's with me. Okay, so pay close attention. I want you to scan this QR code right now, or you can go on the bottom here to retirebydesignevent.com, get started, or you can text survey, SURVEY, to 385-257-9177. Okay, 3 methods. And I want you to go in and complete your survey now. And as a token of appreciation, I will gift you the digital of this book. And then when you meet with an advisor, if you want a hard copy, just let them know and we'll fire one out to you. You're going to love that Entitlement Abolition book. And then when you meet with them, they'll gift you a copy of the Laser Fund. So 500 pages of information. So let me walk you through this. When the survey comes up, it will ask very simple questions, and it will show this screen. If you're on a mobile, though, you're only going to see one question at a time. And I invite you to enter your name. This is confidential information. We don't share it with anybody. And if you decide not to implement anything, we don't sit there and keep, hammering you or selling your number or something like that. You enter your name, email, best phone number. And so as you do that, go through and enter your name and your last name, your best email, and the best phone number so that we can reach you. And then if you are a financial planner or a licensed insurance agent, please be honest. And then you'll be diverted to a page where I recommend you attend an IUL challenge to learn how you can do this for your own clients. And so if you're an advisor, make sure you click that so that you'll be sent there to register for that free IUL challenge, a 3-day, 3-hour per day training. Now, coming back for the bulk of you here, I need 6 numbers because I look at these 6 numbers and I can tell where you're at. And I look at these 6 numbers and I go, oh dear, they're going to pay about $231,000 of unnecessary tax because my brain just goes there. Of unnecessary tax if they don't learn about a strategic rollout, or they don't see about doing this when they turn this age, or whatever. My brain just sees opportunities that you don't see. And so I need these 6 numbers, and then I assign you to an IUL professional who will meet with you and show you different scenarios based on your set of circumstances. So I need these 6 statistics here. Number 1, your estimated annual income. Okay. Again, we keep these confidential. Put down your annual income. How much do you save on a monthly basis on the average? Give me your monthly savings, not annual, monthly. Okay. The third one is the estimated value of all your qualified accounts. Those are IRAs, 401ks, 403bs, 457s, a pension, profit sharing plans. Just give me an estimate of what you have in all of those, because those are yet to be taxed. Then I want to know how much do you have accumulated in non-qualified accounts, okay? Those are usually mutual funds or stocks or bonds or whatever that you've been paying taxes on, unless it's just a regular deferred annuity or something. Everything you have that's not an IRA or 401k. Now, then I would like to know what's the value of all your real estate, and how much do you owe on all that real estate? Because I need to sort of know where you're at as far as your net worth, your income, and what you can qualify for a laser fund or whatever. Okay, and so I need to know what you owe, and then the time zone you're in, and what state do you reside in, so that we can make sure we don't get fouled up on meeting, because these advisors, they can meet with you on Zoom or go to a meeting virtually. And help you the best way with all kinds of illustrations and things that you would like to see. And they're going to give you the resources. If you like to read and learn, okay, my book. If you like to watch and learn, they're going to give you YouTube videos to watch. If you like to listen and learn, they're going to give you audio podcasts. And however you like to learn, they'll give you those resources instead of you having to swipe your credit card on a website to do that. Now, folks, when you have completed the survey, okay, then you will get this screen, which is the workbook. Okay. I really want you to have this workbook. It has that scorecard in it. And my son Emron's coming up next. He's one of the top tax strategists in America. And folks, as you look at this workbook, you're going to want to take notes and sort of see and implement the things that we're talking about. Okay. And so when you get that screen, that means your survey has been submitted. Now, what's going to happen? Here, when my son Emron connects a bunch of dots for you and shows you things that are going to blow you away, at the end, you're going to be assigned to a separate breakout room, a virtual Zoom breakout room, to meet your IUL specialist that I assign you to. I just want you to meet them, and then they can set up an appointment or get back to you and set up a time to meet at your convenience. And then they want to give you resources and links and videos and things so that you don't have to go through 2,700 videos on my YouTube channel. Which one do I watch? They'll know exactly, because I can tell by those 6 numbers. Does that make sense? Okay. Now, here's what's critical. We need to know who you are and make sure that your Zoom name is matching the survey name. So make sure whatever your survey name is the same thing as your Zoom. And so you click rename at the bottom, you enter the new name that matches, and Emron may walk you through this again if you're having any trouble, or people that are helping me right now with those of you who are on the chat. So complete your survey now. Claim your free Retired by Design toolkit that I showed you. And also, as a token of appreciation, please accept my digital copy of Entitlement Abolition, and also the audio and video. And then meet with your professional. I want you to have this laser fund book. And I welcome you to the beginning of an amazing, brighter future as you learn and implement these strategies. Emron, are you ready, sir?
I am ready. I'm excited to be with everybody today.
Okay.
We'll kind of switch out here. And perfect. Well, good. Well, I'm thrilled to be with everybody here today and be able to go deeper into the laser fund and a little bit of some of these strategies here. So thrilled to kind of go a little bit deeper, right? As a society, we tend to go too shallow into things that really matter. And we want to go deep into the things that really matter. Your financial freedom, your financial independence. Okay, so I would love to go ahead and I'm going to go a little bit deeper into some of these things. Now, don't worry. Take your time. Go ahead and finish filling out that survey. Okay, go ahead and finish filling out that survey there. And while we're doing that here, I'm going to go ahead. I'll pull up my presentation right there. I've got that there, and I'll just kind of walk everybody through this a little bit, and we'll go a little bit deeper into some of the beautiful details and the strategies that we like to look at for asset optimization for people. So again, just as a reminder, as I'm going here, go ahead and focus on that survey. You can either click the link. The link is in the chat. Or you can go ahead and by accessing the chat, just go ahead and at the bottom of your Zoom screen right there, just click the little chat button, the little chat icon right there. When you click that little chat icon, you're going to see the link, the chat open up on the right-hand side of your Zoom usually, or on the bottom sometimes, but usually on the right-hand side is where that chat will all of a sudden appears, and then you'll see the link right there. And just go ahead and click on that link. When you click on that link, it'll take you right to the survey. So go ahead and continue to finish that right there. While I'm talking right there, don't worry about it. When you join back in, you'll be able to see exactly, when you come back and focus on what I'm doing here in a minute, I will be getting you'll be able to pick right up where I'm at right there. Now, when you come back, if you're still filling out that survey, as you come back, if you remember, those of you who are, just kind of wrapping up that survey and coming back right here, if you can, take the mouse and right click on your name. So just if you see your little image of your picture or your name on Zoom right there, just right click on your name right there and just make sure if you need to rename your Zoom name to match your survey name. Okay, this is the only way we're going to be able to for our next session here as we get ready to go ahead and pull you into breakout rooms to meet your advisor, right? You're going to get a chance to quickly meet that advisor and to schedule a free consultation with that advisor. Okay, so we want to make sure we get everybody matched up right there appropriately for those that are wanting to do that and filling out that survey in order to request that. So in order to find you, it's just easier if you right click and make sure your Zoom name matches your survey name. Okay, when you right click right there, it says rename, right? Just click on that rename right there and it pulls right up for you. Okay, now as we continue to move forward here, again, feel free to continue to focus on that survey. You can listen to me in the background, and then you can focus on me once you get that done right there. So again, as we look at this, one of the first questions I typically love to go ahead and ask people if this is right for you or not. Let's just find out where you are at. And one of the easiest questions to find out if this is something that you should be exploring is this question right here. What do you believe future tax rates are most likely going to be? I mean, how many of you believe future tax rates are likely going to be lower? How many of you think they're going to stay the same? And how many of you think they're going to be higher? Right? If you think future tax rates are most likely going to have to be higher in the future, okay, especially 15 years from now, and so on and so forth, then you look at yourself and ask yourself this follow-up question. I mean, we really should be looking at these strategies of a laser fund if we see that writing on the wall. Now, if you were a farmer and had the choice to pay taxes on the seed or the harvest, which would you prefer? If you're one person that's like, you know what, I'll protect it on the seed and I'll pay all my taxes on the harvest, IRAs, 401ks, just keep doing what everybody else is doing. You're going to keep getting what everybody else has gotten. However, if you want something better, different isn't always better, but better is always different, right? And if you're looking for something better right there and you're looking and say, no, I'd rather pay tax. I see common sense. I'd rather pay tax on the seed so that I can enjoy my harvest tax-free. Then this is exactly what you should be exploring. You should at least consider this and explore this to see how this could enhance. How can this truly enhance your harvest, right? How can this truly enhance your harvest for you? And so as we get into that, because most Americans, we're told to do, we're directed to go ahead and save what? We're directed to go ahead and save on the seed, right? Traditional financial planning advice tells you to save on the seed so that your harvest is taxed. And ironically, I mean, you kind of follow the money back to where is this advice coming from? Where is the advice coming from to go ahead and do this? Well, it comes straight from, obviously, the government. The government is the one that's telling us to max out our IRAs and 401ks. Why? Because they want to be able to benefit from the miracle of compound interest, right? If you want to understand the miracle of compound interest, I call this the miracle of 93 million, kind of the title of our podcast. And that is the simple fact. I mean, the miracle of compound interest, the most powerful force in the universe. Of course, we want to make sure that we're protecting, and we want to protect, preserve that for ours and our loved ones. We want to be responsible and accountable for this beautiful miracle here. And that's why we're going to go ahead again, look at the advantage of paying tax on the seed and enjoying that harvest tax free. So what does this do? I mean, let me just kind of show you an example of what this has done for one of our clients. Here's a client that took out their laser fund just before COVID, a little bit right around 2018, 2019 is when they took out their laser fund. And in 2021, we went ahead and on the laser fund, I'll show you how we did this and so whatnot. But in 2021, they made $535,000. That was just their growth. Okay, that was just their growth in 2021 was $500,000. Then in 2022, they made another $200,000 of growth. And then in 2023, the market was down between 2022 and 2023. So zero is our hero. We didn't make anything, but we didn't lose anything due to that market downturn between 2022 and 2023. Then in 2024, it bounced back, and what do? We made another $267,000 of growth. Right? There's the rest, there's more growth. And then in 2025, we did another $300,000. So what does that add up to? If you look at that over the last 5 years right here, over the last 5 years, that is a $1.3 million of tax-free growth. This is the results that we're wanting to go ahead and translate and pass on to you as well. There's no reason why you can't do this as well, right? You want to be able to jump on and be able to have that experience, to be able to go in and have and experience the miracle of compound interest, but then also experience it with tax-free, right? The miracle of tax-free compound interest here. So that's exactly what we're looking for. If you want to see other examples of what other laser funds are currently crediting right now, we've got our website, laserfinancial.com. Okay, you go to laserfinancial.com and then you go /IUL Performance Watch. That's L. Performance Watch. Okay, laserfinancial.com /IUL Performance Watch. And if you go there, you're going to be able to see all the different, we're going to show you all the statements. These are actual client statements of what they're currently getting credited. They're going to go anywhere from 5.7% right there up to 32.57%, 8.49, 10%, 10%, 24%, 17%, 12%, 23%, 10%, 6.28%. Okay, we're going to see all the fun miracle of compounding growth tax-free that you can be experiencing as we move forward into this. And that's what really this invitation is we want you to have this exact same experience the tax-free harvest transformation that thousands of others have already experienced through this laser fund, through the laser fund here, a properly structured maximum funded IUL. Now, what is this here? What I look at this right here is, what does the laser fund actually do? What does it really do? Well, it really addresses the three biggest questions that the affluent have, right? If you want to start thinking like affluent people do, to where you have that, you have money, you achieve that ability where you have money, you'll be able to retain that money. Okay. Well, what do affluent people do? Like when you look at like a Warren Buffett's number one rule to money is what? Warren Buffett's number one rule to money is don't lose money, right? Don't lose money. And that's where most Americans, we go ahead and we just immediately jump to question number 2 when we look at opportunities. So when you look at new opportunities, most people are always like, hey, how much money can I make? How much money can I make? How much money can I make? Affluent people think a little bit differently. And it's time for all of us to think like they think. And that is, they ask the first question. The first question before I pursue it on opportunities, I want to know, how are we going to eliminate losses? I don't want to lose if I pursue this opportunity. Isn't that so brilliant? I want to make sure I'm not going to lose. What is the strategy to eliminate losses? Number 2, once we know that we can eliminate losses, then I can go to question number 2, which is, how do I capture gains? And then the unique thing, everybody keeps on asking, why do these millionaires or billionaires not pay as much in taxes? It's because they're asking the third question. Anybody can ask the question. Okay, if you pursue the question, you'll start pursuing the answers. And that is, how do I keep it? How do I protect it from taxes? How do I not just give it all up at the end of the day in the form of taxes? How do I keep it? right? When we ask those three questions right here, we start to find solutions, which is why I love the three greatest strengths of a laser fund. Number one, the liquidity, ability to access my money if or when I need to. Number two, safety of principle, right? I'm not going to lose money. And I'm looking at number three, the miracle of the compound interest, how we're going to be able to grow our money. I want to dive into each one of these three here a little bit more in detail. Starting with number one here, liquidity. So when I look at liquidity, when you go, why do you save money? Why do you grow money? I think most of us save money and grow money so that we can what? So someday we can access it, right? Isn't that why we're doing this? Isn't that the why? And yet most people never discuss the why with their financial advisor. Every year, most people get together with their financial advisor every year. They're always asking, well, how much money did we make? How much money do I have and how much money did we make? Well, the most important question is not that question, because why are you trying to make money? Why are you saving money? Why are you growing money? You're saving and growing money so that someday you can what? Access it. Don't forget the why. From this day forward, I challenge every single one of you to talk to whoever you're using for your retirement planning, for your future planning, who's ever part of that group. If we are part of that group, we want to have this discussion with you. How do you access money, and how much can you access? How much am I going to be able to access in the time of life that I need it the most? Because when we start with the why here, when we start with the why in mind, now we can redirect what we're doing. Like now I know, why am I saving money? Why am I growing money? Is so that I can access it. So that's secret number one. Secret number one is helping you focus on the correct objective, not just how much money do I have. It's how much can I access in the time of life when I need it the most? Because when you access money from traditional strategies, from traditional accounts, let's say you've got $1 million. You've got $1 million set aside in that traditional account right there. And if you have $1 million and you want to access, $100,000, you go to access $100,000 out of the million. What happens to your million? You have to subtract it from the million. You don't have $100,000. You don't have $1 million working for you. You only have $900,000 working for you. So now, if you're going to earn a 10% return this next year, now you're only going to earn 10% on $900,000. And so this is where the issue. This is why Wall Street. You ask any expert on Wall Street, hey, when is the best time to withdraw money from my investments? And every expert on Wall Street is going to tell you the same thing. Never. Wall Street was not designed to take money out of it. Wall Street was designed to put money into it. Now, this is the unique thing. This is what makes an IUL or a max fund or a laser fund so unique. Listen very closely to this, because when I access money out of a laser fund, I get to keep on earning interest on the money. Even though I've accessed money from the strategy, I get to keep on earning interest on that money. So in other words, if I still have $1 million, if I've got $1 million, but now it's inside of a laser fund, if it's inside of a laser fund and I go to access $100,000, I'm going to access the $100,000, but I'm going to access it through a unique strategy. I'm going to be able to access it via a policy loan. When I access it via a policy loan, yes, there is an interest rate tied to that policy loan, but more beautifully, I get to keep on earning interest on my full $1 million. I get to keep on earning interest on the full $1 million. So, and that's been averaging over 10% a year, for example. I mean, we've been averaging over 10% a year for well over 2 decades now. Okay, so if I'm going to be going at that 10% average return right there, and what happens? The rule of 72, if you understand the rule of 72, you take 10% and divide it into 72. How many years does it take to double your money? Well, you're going to double your money in 7 years. So this $1 million has now grown to $2 million in 7 years. But if every year you've been pulling out $100,000, you pull out $100,000 every single year, and it's growing at a 4.5% loan interest on that, well, that loan balance has grown to $838,000. But see the difference here? Instead of having $100 million and withdrawing $100,000, you're only earning interest on $9, and your balance keeps on going down. Now my balance keeps going up, and now I have $2 million minus. Even if I minus the $835,000, I still have $1,162,000 net. Okay, net. My net has grown. My net was $1 million before I started withdrawing. But even if I start accessing $100,000 a year, my net keeps on growing over time. I mean, this is a miraculous. You can access money. You get to keep on earning interest on the cruise you go on next year. You get to keep on earning. That cruise is going to make you money. Now, if I just gave you an excuse to go on a vacation, I don't know what better excuse I can make than that. Go on a vacation and keep on making money for the rest of your life on the vacation, right? This is what's so beautiful. This is what's so awesome about this option right here. Let me show you what happens in a real world scenario. Okay, so I've got a 55-year-old. They want to put away $500,000 into one of these laser funds. Okay, so I put it right here. Here's all the ledgers where we put it all together right here. So I put the $500,000 into the laser fund over here on the left. And I'm going to zoom in because I'm going to zoom in here. At age 55, they're going to retire at age 72. Okay, they're going to retire at age 72. They've got $1.2 million earning interest for them at that time. But they retire and they start pulling out $85,000. They pull out $84,965, and that's going to be at a 5% loan rate. Okay, so it grows to $89,213 by the end of the year. Okay, so they pull out $84,000 at the beginning of the year. By the end of the year, they owe $89,000. Everybody following me so far? But they have $1.2 million covering this $89,000 loan. So $1.2 million minus an $89,000 obligation here gives you $1,124,000 net. Okay, this is your net column. We move forward here. That's just the very first year of retirement. Let's fast forward. Let's keep on doing this right here. And we keep on doing this. And we move all the way to, sorry, I'm trying to get this to go ahead. And there we go. We get that to move forward here to age 90. Okay. And at age 90 here, now we're sitting here. We've been pulling out $85,000 every single year from age 72 to age 90. We have a loan balance here of $2.7 million. Oh no, we owe $2.7 million, but we have $4 million to cover the $2.7 million. $4 million to cover the $2.7 million. My net has still grown to 1.3. And then from age 90, because I am from age 90 to age 100, because I'm earning that small little spread there, I'm earning a spread between what I'm being charged and what I'm growing at. Now you go down here and I've got a loan balance of 5.5. I have 8.5. My net is $3 million. And I've still been pulling out $85,000 a year. I mean, this is just what is so beautiful. This is what is amazing to be able to achieve. That's why we call this a generator, right? Because you don't stop earning the miracle of compound interest on it versus all of your other traditional accounts. Traditional retirement planning is like this battery. So what do you have? Do you have a battery for your future or do you have a generator for your future? When we look at the second strength of the IUL is the safety of principle. We don't want to lose, right? When we look at this, I look at danger number 2, handing over our financial future to the government through things like IRAs and 401ks. An IRA or 401k is not a sole proprietorship. Okay, it is not a sole proprietorship. It is a partnership. And who is that partner? It is Uncle Sam. The government is your partner on those retirement accounts, right? Your name may be on there on the statement right there, but some of that money is owned by you and some of that money is owned by the government. And here's one of my biggest problems. You want to know my biggest problem with an IRA or 401k is? It's when I ask this question: who controls the split of ownership, right? And it's not us, is it? It's the government. The government can increase their ownership in these any day they want by simply increasing or decreasing taxes. Now, I don't see their appetite getting any smaller. I only see their appetite getting bigger. That's why secret number 2 is I implore every single one of you with the challenge to take control back. Take control back. Take control back of your financial future. Most people have money saved for their future. They save in things like IRAs, 401ks, 403bs, 457s, SEPs, deferred comp, pensions, Social Security. They also put it in savings, CDs, stocks, bonds, EFTs, and mutual funds, annuities, and real estate. Now, there is nothing wrong. There's nothing wrong with having money invested in any one of these areas. However, if all of your money is invested only in these areas, they all have one thing in common: taxes. Okay, you still owe taxes on all this money. So what we're simply proposing is to have a balanced retirement with tax diversification. For some of you, that may mean 20 to 40% over here in a tax-free environment. Some of you might mean maybe that gets up to 50, 60% for some of you. But it doesn't usually mean that you need 100% in tax-free, right? That's rare for most people. Most people looking at having to find the right balance to optimize your money in your future usually means somewhere between 20 to 60%, an average of 40% in the tax-free environment right there. And so that's the transformation that we're looking for, transforming yourself into that balanced retirement with tax diversification. And that's what the invitation right there is to look at to do so. Now, one of the easiest ways to do this, let me show you how we completely transformed a 62-year-old couple from San Francisco, California. Okay, they live over in Palo Alto. And when in Palo Alto, I met them, and you met them a few years back. They were 62 years of age at the time. They had $1.9 million. $1.9 million in their IRAs and 401ks. Now watch how we transformed their future, okay? Because their advisor told them, hey, you know what? You're probably going to be able to average 7% on that $1.9 million. And if you take out RMDs when you get to retirement, you know, RMDs are required minimum distributions, and we earn 7%, you'll never run out of money. He's like, okay, that was my current strategy to never run out of money. I got to earn 7% and I got to take out RMDs. Well, instead, we looked at a situation and found a sweet spot. And we found that if we go ahead, starting right now, start now, we start pulling $200,000 out of his IRAs and 401ks before he's retired. And we pay taxes, and we're netting $153,000. And this is what's going over here to his new laser fund. Okay, we're going to transform him from a taxable future to a tax-free future. Okay, we pull this in. We have proprietary software where we can help find the sweet spot for you. His sweet spot was it was going to take a 15-year transformation. Okay, we wanted to be strategic about it. So for his situation, we wanted to be strategic, and so it was a 15-year transition. He's going to retire during these 15 years. That's totally fine. The transformation can still be going on while you're retired or you're already retired, right? That's plenty fine. Okay. But let's see what the results look like. Because right here at age 70 and a half, when he was going to retire, okay, he would have had $3 million in his IRAs and 401ks if he would have left them there. Okay, that means he would have $2.1 million that's his tax liability. His tax liability is approximately $1.1 million. Okay, well, he's not going to pay taxes yet because all he's going to do is take what his advisor tells him to do, which is take out RMDs. So he's going to take out his RMD at age 70 and a half. An RMD at that age would have been $119,000. Most of you don't need to take out RMDs until age 73 on this webinar. Maybe you even use some a little bit longer if you're younger, but age 73. But he was going to start starting this at age 70 and a half. An RMD at age 70 and a half would have been $119,000, $120,000. He's got to pay taxes of $40,000. Okay, so that means he's going to net $77,000 that him and his wife get to go spend. In contrast, the money that we moved over here to the laser fund each and every year, starting at age 70, is providing him with $233,000 a year tax-free. And that lasts until age 120. And actually went beyond age 1. He said, stop, Emron, I'm not going to live past age 120. It's okay. I know I'm not right. It's great. That's fantastic. Because even let's say he's like, let's just take me to 100. Because if me and my wife, if one of us make it to age 100, what does it look like? Well, at age 100, if you would have left your money in your IRAs and 401ks, you would have left behind to your loved ones after you passed away, you would have left behind $1.2 million net after tax. Compared to the laser fund, even after taking out your income, you're going to leave behind $2.6 million. And during your retirement years, you got to spend and enjoy $7.2 million tax-free. Compared to the RMDs, net after taxes, you only got to spend $4.8 million. So you got to spend 4.8 compared to 7.2. I mean, I'd rather have 7.2 all day long and leave behind twice as much money. I mean, if you add those two together, that's a total asset value of $9.8 million compared to $6 million. Folks, that is a $3.7 million increase or a 50% raise. How many of you could afford a 50% raise? All of that hard-earned money, your future that you saved for, if we could get you a 50% raise on your serious cash, I mean, what would that do for you? That's what I call a transformation, right? We can transform. I mean, how many of you would turn down a 50% raise from your employer? None of us would. And that's what we're talking about here. Transforming you from a taxable harvest to a tax-free harvest, right? This is what we're looking at trying to transform you for. Now, in your workbook if you fill out the survey, you got this workbook. This is going to guide you through some of this as well. When you sit down with one of our experts, they can take you through that workbook, and they can actually help, as you're telling them this information right here, they can then help you then create this transformation for you. Now, the last thing that I wanted to cover here today was going to be the rates of return. What kind of growth can you expect to experience, and how does the growth work inside of a laser fund? Well, like Warren Buffett said, the number one rule to money is don't lose money. In fact, the second rule is don't forget rule number one. Okay, so when we look at this, if you have something like that, because most advisors, a lot of the plain Jane financial advisors are like, hey, just go buy the S&P 500. Well, the challenge, if you go buy the S&P 500, you don't have a strategy in place around that. When the S&P loses, you lose. And that violates the number one rule to the affluent. How do we eliminate losses? Well, the wonderful thing about a laser fund is it does exactly that. It guarantees that you will not lose when the market downturns due to that market downturn, right? You will not lose due to that market downturn. So what does this do? Let me kind of show you, and then we're able to capture these gains. What I want to show you what the indexing does in a real world scenario. Okay, I'm going to take again another client of ours, Brian and Stacy, who began their laser fund at age 50. Okay, they had $600,000 in savings from an inheritance that they received and some other savings that they had of their own. We're going to put that into their laser fund over the next 4 years, and then they're going to save $15,000 for the next 20 years. So from age 50 to age 70, they're going to save $15,000 a year. Okay, $1,250 a month. We're going to simulate that in a laser fund utilizing the S&P 500 from March 1980 to today. We're going to simulate what would this done? Losses, gains, when the market loses, when it gains, when it caps. We have caps on ours, everything else. What happens here? So the first thing we're going to do is we're going to eliminate these losses. Okay, we're going to capture as much of this growth as we possibly can inside of the IUL by using the strategies that we've been utilizing and implementing for nearly 30 years now. Okay, so what happens here? So now you look at, here's the S&P 500, for example. Here's the S&P, you're going to see right here. In all of these years, right here, we're going to make sure zero is your hero. We're not going to gain, but we're not going to lose. Okay, we're not going to gain, but we're not going to lose right there. Now, in each one of those years right there, we're also going to apply some of our simple strategies that we like to employ. Okay, I use a simple employment here right here. What happens? Let me ask a simple question. What happens when the market crashes? Whenever the market crashes, it recovers. And recovery years are your most opportune years in a laser fund. So these opportune years right here is where we're going to be able to earn some of the best returns in that laser fund. So what happens here is we look at this. So say, for example, the last time this happened was in March of 2020, the market crashed. Everybody remember that? COVID happened, the market crashed. Well, a year later, March of 2021, our clients in their laser funds in this particular company here, we had hundreds and hundreds of clients receive a 61% tax-free return. Okay, 61% tax-free growth. This client right here had $872,000 in his laser fund. It received a 61% rate of return. That means he earned $535,000. So $872,000 became $1.3 million. Now let's see what this. So this $870,000 made $500,000 in that 1 year. We can do that each year. Each year, the market kind of crashes. We look at that. And by doing that, by age in over 42 years, this client right here over 42 years, this is the value of their laser fund. Okay, this is their value of their IUL right here. This is how much money they're earning interest. They got $21 million. $21 million by simply following our advice and by following our instructions here. Versus right here, here is the S&P 500. If you just buy the S&P 500, buy and hold. You buy and hold the S&P 500, $11 million. $11 million compared to $21 million. Now that's more than double. Did you know that less than 5% of the smartest money managers in the world outperform the S&P 500? And I'm showing you how you here and with your own laser fund, you could double the value of the S&P 500 over those same 42 years. That is the power of that. Again, you can take the path that everybody else is taking. You can take the S&P 500 path. And if you just take the pure S&P 500 path, you're going to go up and down, up and down, up and down, and pray that you make it. You can hope and pray. Otherwise, you can exercise faith by taking action. That's what we look at here, and that's what we achieve right there with the laser fund. Okay, the laser fund right there, it has that opportunity to protect your money, preserve and grow it inside of there. So like that client I told you, he made $535,000 in 2021. He made another $200,000 in 2022. Again, nothing in 2023, another $267,000 in 2024 and in 2025. So once again, over those last 5 years, he has $1.3 million of tax-free growth. That's not what his balance is worth. That's just the growth. Okay, he's got his principal on top of that, right? You got the $835,000 principal plus the $1.3 million. Okay, so he's got over $2.1 million in his account now. That $835,000 he started with in year one right here, plus this $1.3 million. I mean, he's at $2.1 million. $2.1 million of this as his total balance right there. That is it. That is the vision that we're trying to cast for you, transforming you from this dilemma into this kind of a balanced future. That's what it means. That you can, people sit here all the time and they just kind of settle for a meager harvest. You do not need to settle for what everybody else is settling for and just a meager harvest. You can enjoy the beautiful harvest is still within it's still there for you to claim. And again, you just have to ask the questions. That's what it's all about, asking the right questions and getting the right information. Getting out of the rat race of the losses and the gains of the market, and capture only the gains of the market and eliminate the losses of the market. Okay, that's what's beautiful. The laser fund right there. Again, the IUL right here that we talk about, the Index Universal Life Insurance Policy, is the club. When we combine it with the swing, that's what makes this a laser fund. A laser fund is when we actually properly use the club. It's a properly structured, maximum funded IUL. That's what we're looking at. That's what's so beautiful about this right here. Okay. So again, join the thousands. I implore you to join the thousands of who experience the laser fund tax-free harvest transformation, achieving financial freedom and financial independence. How does this work? Well, the answers. This isn't all fluff. This isn't all a secret. It's right there in the tax law. When the affluent people ask the question, they get the answers. The first answer right here is this. These are your tax laws. This is what makes a laser fund work, is the Tax Equity Fiscal Responsibility Act. It's the Deficit Reduction Act. It's the Technical and Miscellaneous Revenue Act. When you work with somebody who understands these tax laws, you now qualify to achieve these three sections of the Internal Revenue Code. Internal Revenue Code, Section 101A, Section 72E, and Section 7702. Once again, this is not a tax loophole. A tax loophole is something that is not inside of the Internal Revenue Code right now. It's something that they haven't thought of. No, this is something that's very intentional. This has been intentional for over 100 years. This has always existed in our tax code. This is why the Rockefellers and other affluent people have been pursuing this for their way to preserve and protect their wealth for hundreds of years. Okay, this is very, very intentional right there. So what do we do? When you meet with one of our specialists, again, your job, when you're meeting with them, you want to understand, think of this like a bucket of money. You're going to create a tax-free bucket of money. Now, what is the size of your bucket? You want to make sure the size of your bucket equals the money that you want to put into this, right? It needs to equal your money, the money that you want to put in this. And as they do this, as they structure this, they'll structure that correctly to make sure that when you fill it up, the biggest secret, let me tell you right now, if you want an IUL to work, if you want it to operate, you want it to succeed, it's making sure that there is no vacancy in your bucket. Okay, you want your bucket to be 100% full. The biggest challenge with a lot of people, it's like owning a piece of real estate. Okay, your laser fund is like owning a piece of real estate. If you go out and buy a 5-story office building, how do you make money? You make money by leasing out the building, right? When you lease out the building, you turn it into a cash cow. If you leave the building vacant, not only do you not make money, you're going to lose money, right? Can you lose money in a laser fund? Well, yeah, by not leasing out the building, you'll lose money because it's not, you don't even have the opportunity. You're not even giving yourself the opportunity to make money because you're paying for the asset. You're paying for this asset, and the asset does have expenses tied to it, but the expenses are minuscule. They are insignificant when I lease out the entire building. That's what makes real estate such an attractive asset. Well, the maximum funded index universal life insurance policy, the laser fund, works the exact same way. It's just as attractive, if not more attractive, because my growth is what? It's tax-free. It's like going out and buying an office building and the IRS is saying, hey, you can have all of your rents and leases on this building tax-free if you structure your building correctly. Well, yes, why wouldn't I do that? I would do that all day, every day, 7 days a week. Okay, so again, to help you structure that, we've got a couple of extra pages in here in your workbook to help you understand how to structure your own personalized, customized, maximum funded index universal life insurance policy or your very own laser fund. Therefore, you then are right there. You're putting yourself in a position to where you will now start experiencing the tax-free harvest transformation. You'll be joining the thousands of other people that are so much more, they're happy and they're confident about their financial future. Instead of wondering what's going to happen about their financial future, they're making it happen. They're making their financial future happen, right? They're taking the positive, the proactive approach to that financial future. So again, what does this look like? When you sit down and meet with one of our specialists, as we look at doing this, step number one when you meet with a specialist is to have a discussion about where you are and where are you wanting to go. So where do you want to get to? Where do you want to get to, and where are you right now? Right? Those are really the biggest. That's the thing you want to get accomplished. Because if we want to understand where you want to get to, we want to understand where you're at, so that we can do what? Step number 2, we can build you a customized plan to get you to your goal in the most tax efficient possible. Instead of working harder, we're going to help you understand how to work smarter. Right? How to be smarter with your money. Make your stretch that dollar so that it lasts so much longer, right? That be smarter. We're going to help you be smarter with your what? With your money. That's exactly what that is. Step number 3 is that we're going to refine that to make sure it's going to what? To make sure it hits the bullseye. Okay, we want to make sure that hits your financial bullseye, so that it's truly going to increase the probability that you will achieve your financial goals. Okay, that's what we look at. And then step number 3, once we know we're going to hit the bullseye, once we know we're going to hit that bullseye, then we're ready to start implementing. You don't take a shot at the bullseye until you know you're going to hit the bullseye. Right? Now we're going to shoot, and then we're going to start implementing, and now we're going to start hitting that bullseye for you. And we're going to meet with you every year, annual reviews, to hit your goals and optimize performance for your IUL laser fund, especially during the critical stages of getting that structured and set up and funded. So again, the first step right here, number one step we need to do right here is to schedule your free consultation with one of our IUL specialists. We're going to do that for every single one of you that have filled out our survey right here. We want to give you that opportunity to do so. And we're going to put you in a breakout room where you can meet with them, and you can schedule with them right here, right now. Again, your schedule within the next day. Look at your schedule, start pulling out your calendars. You'll be able to meet with them right here in a little bit. Now, when you meet with them, they're also going to empower you. We want to empower you with knowledge so that you can make the best decision for yourself. How do I empower you with that knowledge? Well, we're going to gift you a digital copy of the laser fund. And if you want a hard copy, just ask your specialist right here. Just ask your specialist, and they'll mail you out a free hard. If you like a tangible hard copy right there, they'll mail you out a digital copy. Right? They're also going to gift you a audio version of the book. They're also going to gift you access to our laser fund masterclass. Okay, so you can go in there and you can attend and watch the master class. It's you've got that ability to attend that worth $1,000. You don't have to spend $1,000. They're going to gift that to you. They're also going to waive any of their fees to design a custom plan, a customized strategic rollout report and plan worth $1,500, and also the customized laser fund structure. Okay, to get the laser fund structured correctly for you, they can go ahead and look at that. They can design that for you. They'll waive any of their fees to use their expertise, right? You get the value of their expertise without even having to pay them for that expertise. They're going to waive that fee. They're going to waive that fee. That adds up to over $5,000 of that value right there. And as a today only bonus, like Doug mentioned right there, you're going to get the full entitlement abolition bundle for free as well, to be able to help your family understand that it's about more than the money. If you want to understand how to create a family bank, right there, you're going to have some of the resources and instructions to help you on your way to creating a true family legacy for you and your loved ones into the future right there. That's all free. Okay, no cost or obligation to do anything right there. You'll get that when you meet with one of our IUL specialists. Now let's get you there to get help you to get you meeting with them. Now also, as an extra bonus, when you meet with them, how many of you can remember everything we taught today? And how many of you would like a copy of today's recording? Well, if you want a copy of today's recording right there as a token of our appreciation for filling out the survey, we're going to give you a replay of today's webinar. Okay, so anybody who fills out the survey will get a copy of the replay, and that's right there for you as well. I mean, if you're not going to fill out the survey, why would you need if you're not going to move forward? Why would you need the replay? I mean, again, this is for those that are looking at wanting to go ahead and actually take action on the information and knowledge. So right here, if you haven't already filled out your survey, if you've already filled out your survey, you're good to go. You're good to go. But if you haven't filled out your survey yet, either scan the QR code or text the word survey to 385-257-9177. Again, text survey, the word survey, to 385-257-9177, or simply click on the link in the chat. Okay, go to retirebydesignevent.com/get started. Okay, you'll be able to click on that link in the chat. We'll have one of our team members go ahead and post the link in the chat right there. If you want to open up your chat, again, it's just at the bottom right there. Go ahead and grab that. Just open up the chat right there, and then your link is right there in the chat. Just click on that link, and you can fill out that survey. Okay. Now, what we're going to do here is for all of those who have filled out their survey, we're going to go ahead and pull you now into a breakout room with one of our specialists. You're going to be assigned to one of these specialists. You're going to be introduced to them, and you're going to have a chance to go ahead and schedule your free consultation. That is the most important thing. You got to get scheduled a meeting with them so you can get access to all of this and help you on this journey to transform your financial future. So we're going to automatically pull you into these breakout rooms. Again, only those that fill out the survey are going to get automatically pulled in. So we're going to go ahead and do that now. We're going to go ahead and activate those breakout rooms, and you're going to all get sucked in. Okay, the technology is going to suck you into these breakout rooms. So just sit back, and it stays on Zoom. You're going to stay right here on Zoom, but you're going to eventually go right there. You can see everybody's like, all of a sudden people are disappearing off the screen. They're gone. They're going. Twilight Zone. No, they're not going anywhere. They're actually just getting pulled straight into their breakout rooms. Okay, so again, if you're still filling out the survey, once you have your survey filled out, give us a minute or two. Give us maybe up to 2 to 3 minutes to go